Hi, everybody. Hopefully, you can hear me loud and clear, and great to be back. And we are on NinjaTrader. And just to pick up on what Anna was saying, we managed to escape to Italy for a couple of weeks. We decided to make a very fast trip abroad. We always drive, so it's a 2,500 mile round trip, which we managed to do in a couple of weeks. And we managed to squeeze in some sailing. We got out in the in Salonika Bay in a lovely catamaran for a couple of days, and we saw the dolphins. But then at the end of the holiday, we managed to contract COVID on the way back. So it kind of took the gloss off the holiday, I have to be honest. And we've just about recovered now. You certainly wouldn't have wanted to hear us last week, that's for sure. So if I switch off, it means I've started coughing. So apologies in advance. Um, I just want to pick up on just looking at the indices. We'll look at the indices. We'll go to Tesla because Tesla results will be coming out fairly soon. And for a heavily bearish trader like myself, I love days like this. I love what's going on in Tesla. Those of you who come along regularly, you'll know that I have a huge bias to the short side, which I'm well aware of, very conscious of all the time. And it's something you have to live with. The reason I have it is because markets move much more quickly to the downside than they do to the upside. It's just a fact of life, and therefore I'm always looking for shorting opportunities. Of course, I trade to the long side, but if I see a shorting opportunity, and I'll show you a couple here, and the sort of candles which fill my heart with joy, because when I see them, excuse me for a moment, because when I see them, I am immediately looking for the opportunity, provided it's backed up with volume and the volume story is good, then they just really confirm it for me. I wanted to start here because if you're going to be trading index futures, Anna's mentioned index futures, mentioned the SPY obviously a great deal. If you're going to be trading index futures, then please do not start. If you've got no experience, do not start with the top line. On the top here, we've got 1 minute time frame, and I've got the YM, the Russell, I've got the ES, and I've got the NQ. They are the full-blown futures contracts. They are big money. You make money very quickly. You will need a very sizable amount of margin to trade even just one contract. If you're trading multiples, even more so. You will make money very quickly if it's moving in the right direction. You will lose money equally quickly if it goes against you. So my advice is very simple. On the layer below, on the 4 charts below, we have the micro futures. We've got the MYM, the M2K, the MES, and the MNQ. So if futures are new to you, please start with the micros. I can't stress it too strongly. They are a tenth the size. So if you're looking at something like the YM, and there are variants of the YM, there's the small Dow and the big Dow. The big Dow is $25 a point, but the more popular one, I would say, is the straightforward YM, which is $5 a point. Then if you look at the MYM, you're a tenth of that, so you're 50 cents a point. So if the contract goes 15, 20 points against you, it's a handful of dollars. And it's much more manageable. You will still learn in the same way. And the reason I put them up here is because quite often when you see these micro contracts, these are pretty new. They've been out about 3 years now, I think. They are hugely popular, hugely liquid, and you can see how the price action, although you're looking at different time frames, you can see how liquid it is. It flows very nicely. It's not gappy. When you look at some contracts, some futures contracts like gold, for example, you look at the micro gold contract, the MGC, same principle applies. It's a micro, it's a tenth, but the price action is very stuttery. It stutters. It'll move a little bit, maybe get a candle, and then it'll stop, and you'll get 2 bars appear, and then it'll move on again. And it's just not what you want to see, because it makes reading volume price analysis very difficult. The reason I highlight these contracts is twofold. First of all, to tell you that they are available, because some traders are not aware that they're available. You can see how bearish we are at the moment. We're still falling away quite strongly. Really nice move. and that's reflected on the 5 minutes. So, and on the micro contracts themselves. So please start with the micros if you are new to trading the index futures. We started in a most bizarre way, as some of you, I'm sure many of you know. We started trading full-size contracts. We didn't know they were full-size contracts at the time. That's just the way we started at £10 a point, trading FTSE futures through the Liffey exchange. I don't recommend you start that way. Our journey into trading and investing was very odd. The highlight of it, and the thing that we are eternally grateful for, is that we started with volume. Many traders, many investors come to volume after they've had a tortuous journey of losing money, trying this, that, and the other, and really not succeeding, and can't really understand why. As I'm talking to you, my eyes caught immediately by that volume spike that's come in. You can't miss these things. They just hit you between the eyes. You've got a big down candle up here. And the other reason that I like to have all four up is because Anna mentioned relational analysis. Now, you might think of relational analysis of obviously the dollar and commodities. And I've got dollar and gold up, so we'll take a look at that shortly, which is a very traditional relationship, commodities and gold. But you can also think of relational analysis in a much more simplistic way, if you like, where we are looking at four instruments here for related markets, but nevertheless, they don't always go in the same direction. On occasion, you'll find some indices going up. You'll see the NQ leading and the others maybe lagging or maybe even going the opposite direction. So this is another aspect. It's a very simple aspect of relational analysis. You can all do it. You just pull up these charts, put them alongside one another, and instantly you get several things. You get a different view of volume price analysis because the candles are not all identical. They are at the moment, but often they are not. So you get a view of volume price analysis. And it also gives you a confirmation that the trend that you're trading or the trade you're about to take is confirmed across that piece of the market. In other words, the sentiment, the global sentiment towards equities, US equities at any rate, is either risk on, risk off, or going sideways. Clearly at the moment it's risk off. The markets are falling. They're falling quite strongly. The only thing we've got to be conscious of is the fact that we are coming towards the end of the session, and therefore it's a question of how close do you want to get to the end of the session before you either allow your trade to roll through into the next session or you close out ahead of it. Those are decisions you have to take at the time. And the same sort of decision applies to trading intraday for Tesla, for example, where we've got Tesla now. We've had a very nice move lower, but we are very close to an earnings announcement. So clearly, you don't want to be in there unless you particularly want to be, but I would suggest you don't. If you're day trading, most people would have closed out some time ago, or they would be in the options market looking at options strategies. Now, options is something we cover in huge detail, and options are, Anna mentioned about the bond market being so critical now, an understanding of the bond market and knowing what is going on in there. I would say the same applies to the options market. 15, 20 years ago, the options it wasn't quite a backwater, but it was certainly a more specialist market. Now it is hugely mainstream. It has a massive impact purely by virtue of the tsunami of volume that goes through the options world. And if you don't understand and correlate the options with stocks, with what is going on broadly across the sentiment of the market, then you really are going to struggle, certainly from an intraday perspective. If you're just trading intraday stocks, fine, okay, but you've got to understand what's going on in the options world simultaneously so you can marry the two together. So you can see what's going on here. We're still bullish, still bearish rather. The other reason for having multiple time frames up is you see things that you wouldn't necessarily see elsewhere. For example, if we look across the top line, we can see that for a while here, we were trading very much around the volume point of control. This yellow dashed line here was the volume point of control. So if we're on a slower time frame and we're seeing that, then it gives us a heads up as to why perhaps the market has stalled for a little bit. Well, we're at the volume point of control, and we were at it on all four of the indices across here. And these are the sorts of things you're looking for in multiple timeframes. You're looking for validation, you're looking for information, you're looking for pieces of the jigsaw puzzle which tell you things about why a market has stalled. We've got this ton of volume coming down here on 5 minute. It's come in pretty much universally across all four of the indices, as you can see here, the micros. We've got a nice wick to the lower body of each of those candles. What is that telling us? It's telling us loud and clear that there is some serious buying has come into the market at this point. So at the very least, we are expecting a pause point. We may get a bounce coming into the last 10, 15, 20 minutes, which wouldn't be a great surprise given the amount of volume that's come in. But if you're short this market and you see that, it really is time to bank your profit and just say, thank you very much, I'm off. Because, as I say, it will either go sideways or it will bounce higher. Why? Purely based on one very simple signal with this high volume that's suddenly come in just after 2045, 2050, 2045, 2046 our time in the UK, because it's now 9 minutes to go to 9 o'clock before the close of the US session. And you can see it throughout. It's even clearer here on the Russell. You've got a ton of volume comes in, you've got a wick to the lower body. What is that telling you? It's telling you there is buying in there. There has to be, because if that were not the case, this candle would be down here. It would have closed with a wide spread. It hasn't closed with a wide spread, it's closed with a narrow spread. What does that imply? It implies there has to be buying in here, which has forced the price back up. And you've got good volume under it, so it's telling you it is a serious, serious level of buying on that particular time frame. Now, I mentioned at the start about the candles that I always look for, and you've got some lovely examples here, and there's one that really just stands out, and there's this candle here. You've got it here, you've got it here, and you've got it over here. Perhaps if we pull this one up. And again, it doesn't matter what time frame it is. It happens to be 5 minutes. In this case, you've seen the start of the session. We've had quite a bit of oscillation around the volume point of control. Maybe you didn't fancy any of this stuff up here. Maybe you set some levels. You've got a floor of level, possibly to the short side. You think maybe this is going to break to the short side, but you've got 2-bar reversals and you've got lots of things going on in terms of the volume profiles as well. But when you start to see things like this, and you've got much the same here, it's this sort of candle, but when you see it in a downtrend, this big wick to the upper body, it's preceded by some narrowing price action. So the spreads are narrowing, the volume's pretty low. In other words, this has really not got any great momentum. There is no great desire to move higher here. The volume is below average at best. So the market is pretty weak. It's trying to recover a little bit, but it's really not going far. And then you get one of these things come in, and then you start to see the move unfold. And it's also punctuated when we get to these little congestion phases, which are inevitable. You get a little bit of buying coming in under that one, but you get another effort to rally, but it's on really weak volume. The market has tried to rally. You've got a wick to the upper body, bang, on down we go. I cannot tell you. It doesn't matter if you don't get in on that one, but once you see these things coming along, they are great confidence builders that, yes, we are going in the right direction. And it's just a question of waiting and being patient for them to arrive. And they arrive in all downtrends. Got them here. And the reason they arrive, this is the one here, the similar one, effort to rally. And on down we go into our price waterfall, bit of congestion developing here and on down again. They occur in all time frames, very strong intraday candles. If you don't get into a price waterfall early, it's fine. All you do is wait for a congestion phase and wait for one of these to come along, or two if you're lucky. Maybe you'll see a little rally. That little rally will be on weak volume. Then you'll see these candles here. This is basically the market makers or the insiders selling out on stock they've had to accumulate, or contracts they've had to accumulate on the way down. They push the market up. There's really no reason for it to go any higher. They're selling into weakness anyway, but they're having to sell back to the market. Down it comes again, and on down we go, on to the next level down. It's a hugely important candle to look out for. And equally, the opposite of that is when you see a hammer candle to the downside. When you see the market rallying, you'll see the market rise, it falls back, you'll see a deep lower wick to the body, lots of volume coming in. It's telling you the buyers are stepping in again. They don't want this market to reverse, and on up we go. So it's exactly the opposite in terms of a mirror. This is what I said about the bounce, and no great surprise. And all of that has come as a result of one candle and one piece of volume. And that really encapsulates volume price analysis. It encapsulates the power of volume price analysis. Yes, of course, there are many other aspects. Yes, of course, we put it together with all the indicators as well. But that is the foundation methodology on which we build everything, including all the new indicators which we've released on TradingView, which are volume-based. All three of them are volume-based. And I'll run through them very quickly for you. So that's where we are. We're coming to the end of the session. And just one other point to highlight on here, I put the two other indicators, just got one other indicator on here, which is the volume point of control. Just to remind you that the volume point of control works in, well, there are two aspects to it. First of all, we've got our volume point of control here, which tells us where we are, whether the price is in congestion. More importantly, when price is approaching it on a different time frame, it tells us that if the price gets there, then we like to see congestion. So it's equally important from that perspective. But in addition to that, we have the histogram here. And volume works in precisely the same way as it does with price-based support and resistance. And by that, I mean, where we have deep areas of volume, then expect price to congest. Where we have low volume nodes here, where we had here, for example, expect the price to move through there fairly rapidly, because there's nothing in the way to support it from a volume perspective. So where you've got price coming up to a low volume node, happy days, the price should move through there pretty rapidly. If it's coming up to a high volume area, then expect the price to congest. Let's just go and have a look at Tesla.